I really thank Glenn for his talk as a witness, in a certain sense, of an attempt of this tool for, face the euro disequilibria, as we have said for the name of this session. It surprised me, I mean, during this day, I have counted the word growth an incredible number of times. I mean, it's impressive. But Glenn has, used this word a lot of time. And this is, in my opinion, the maximum common denominator of what we are talking today. The problem is growth. We need growth in order to face the disequilibria by adopting a fiscal currency. But actually, by making one step back, we need growth to move the denominator of the debt to GDP. Because as we have seen in the morning with the difference between R and G, yes, we can see our problem with the numerator, but we don't need to be a mathematician to understand that if we move the denominator, the problem can be put under control. It's like the problem of deflation, as we have seen the fact that what is the right way? That we move towards Germany, or Germany that has to move towards Italy? And now what is important to face at this point is this tool that, in my personal view, definitely is a win-win tool if we would decide for an exit. Because you will have no way. You will need time in order to, you have to gain time. And you will have to cheat a little bit. And since you have to cheat a little bit, it is clear that in the period in which you have to cheat with the market, with institution, whatever, it is clear that you need a fiscal currency. And it's not the case that Glenn was saying, we were thinking about using this tool for the public employees. Some decades ago, I remember when there was a solution of paying the 13th month salary with the BOT, with the govies in Italy, because they are used to stay in the same place to work. Eventually, they will also accept this. So what I'm saying is that if growth is the right word for all this speculation and analysis, maybe that we have to reinsert this word instead of austerity in our reasoning, and I'm sorry that somebody has told during this day that austerity has not been implemented within the Eurozone, because actually sometimes it's a question of figures that we have to, it's the usual question of mathematician. 2 + 2 makes 4. That is a very important question. Sometimes yes, sometimes no. In economics, in quantitative finance, it does always 4. But in any case, now I ask Luca to complete the picture about this fiscal currency, according to his brilliant capabilities, and then we will pass to the fourth question, where I have promised, and I will tell you, it will be a very interesting question, because you will have institutional investors, hedge fund manager on your desk. And as I promised from the beginning, and also during the break, we will also deserve sometimes to question from the audience that the parterre definitely will be able to answer. Okay, Luca.
Grazie, Marcello. We are running late, so I will try to keep it as brief as possible, but I do want to start by thanking the organizers of the conference for having created a rare opportunity of discussion among people who have very diverse backgrounds. And I think this is badly needed, particularly in the current times, which need diverse approaches to problems that we have trouble dealing with the more traditional approaches. What I will be talking to you about is a proposal which, as Marcello anticipated, is a complement to the fiscal currencies that have been discussed by Gennaro and by Glenn in their presentations. I want to tell you two words about the backdrop against which this proposal is set forth. And I think that the backdrop that we have on this stage is quite appropriate to illustrate what I mean. As I was listening to the previous speakers, I was looking, as you are, at this stage where we have the Euro flag and the Italian flag. And a lot of what has been said until now seems to force a choice between this side and that side, between leave or remain, between lira or euro, between integration or disintegration, however you might want to call this. Now, what I will be discussing is whether we can devise a middle way which manages to reconcile these two options, which obviously both have some merits in their own. A lot of what has been said goes in the direction of putting us in front of the problems of being part of a monetary union and what we have to renounce in terms of the possibility of having an autonomous monetary policy, of pursuing domestic goals of full employment and exploitation of resources and excess capacity and so on. But we should not forget the reasons why we entered in this project in the first place, which are reasons that have to do with creating a common market and possibilities of competition, and I'm sure you are familiar with all this. So what I will be discussing is the possibility of changing the rules of the monetary union in ways that I will briefly illustrate, starting from what Gennaro left open. He discussed at a certain point, presenting the fiscal currency, two major economic risks of introducing a fiscal currency, namely the possibility of creating inflation and the possibility of exacerbating or creating current account deficits. I will focus on the second aspect. Of course, as Gennaro rightly pointed out, this is not a primary concern today in Italy, thanks to the current account surplus that we have managed to have for the past few years. But as many discussants have stated, current account imbalances have been one of the major problems that led to the euro crisis in the first place. Particularly, Alberto Bagnai was telling us how this has become mainstream at this point, finally, to illustrate the euro crisis as a balance of payments crisis. And I think this picture gives you, just in one screenshot, a synthesis of this. What you have here is current account imbalances in blue for Germany and in red for what were once dubbed the pigs, with two eyes. There's Italy there as well. Starting from the date the euro was introduced, an accumulation of current account surpluses on the part of Germany and of deficits on the part of the peripheral countries. That this was no coincidence, I think that Heiner Flassbeck discussed extensively. One of the reasons behind this is the fact that Germany benefited from what we might call a depreciation of the real exchange rate throughout this period. I want to focus more on another aspect, simply the other side. The fact that these current account imbalances of peripheral Europe have been financed through capital movements throughout this entire period. And the EMU is part of the story even here. It's no coincidence. These capital movements from the core to the periphery have in fact been encouraged throughout this period by two factors. The single currency, which of course reduced or rather cancelled the exchange rate risk, encouraging to invest in the periphery, and the gradual liberalization of capital movements across the euro area. Of course, This also, well, here you have the remainder years where you see actually that the crisis itself has produced a convergence of the once deficit countries towards the zero. But it was only the depression that produced this. In the meantime, here what you see is the composition of sovereign debt holders for Italy. What you're interested in looking at is the red part on top, which shows you the portion of Italian sovereign debt which is held by foreigners. You can see that in 1997 it was still a relatively small proportion, around 20%. It gradually increased until the outbreak of the crisis, 2008, exceeding 50%. So the dynamics I was discussing have favored the internationalization of sovereign debts across Europe. The crisis itself, even here, produced a step backwards. A divestment of foreign investors from Italian sovereign debt, and now we are back to less than 40%. Now, the dynamics are well known. I will just show you a couple of pictures that stress the point for the case of Italy. This is the cumulative financial account for Italy. These are capital inflows throughout the period from 2002 to 2012. With the stud and stop we experienced in 2011 and massive capital outflows. Total inflows were not affected as dramatically. They, in fact, continued slightly to increase until leveling off in 2013. And what explains this is, of course, as you have been reminded, the intervention of the European Central Bank. So it was the refinancing operations carried out massively by the ECB that allowed these capital flights to be financed. As someone was putting it early on this morning, the bailout of the creditors in the center through the intervention of the European Central Bank. Particularly with the use of an instrument which has become familiar to most of you, namely the Target 2 system, which again provides a very clear picture, I believe, of what has been going on in Europe throughout the past years. You have here a clear depiction of the relative position of the northern countries, or the southern countries, let's call them this way this time, with the accumulation, starting from the outbreak of the crisis in 2007, of very strong creditor positions, particularly by Germany, which is obviously the blue line there, which reached in 2012 the figure of roughly 800 billion euros, to decline slightly afterwards and only to pick up again in more recent months until reaching the current records close to 900 billion euros of credits towards the European Central Bank. On the other side, we have the peripheral countries that are now being led by Italy here in green, which has accumulated, again, in recent months, a figure which is rushing towards 500 billion euros. What is Target 2? It is a clearing system managed by the European Central Bank, which we should say had stopped doing its business of clearing international payments across the Eurozone. You can see quite clearly that until the outbreak of the crisis, the Target 2 system was doing a perfect job. Or rather, the financial markets were doing a perfect job in providing the funding for current account imbalances. What happened in 2007, we have seen. Financial markets stopped financing current account imbalances. In fact, they have reversed. So we have had a flow back from the periphery to the center. And the difference has been made up for by the intervention of the European Central Bank, which has literally created a synthetic form of means of payment for international transactions. It's like synthetic gold, okay? This is the only thing that has kept the Eurozone together until now. Otherwise, the elements that Marcello was pointing out before would have been even more dramatic in terms of spreads, in terms of diversification between euro lire and euro marks and euro francs. So this is what is keeping the euro together. what is the problem with this system? It's that it's financing the imbalances, it's making them possible, but it is doing nothing to reabsorb those imbalances. It's doing nothing for the purpose of integration of Europe, for pursuing the goal that even the most favorable sustainers of Europe deem to want to pursue. So what can we do in order to achieve this goal of integration? Well, here the source of inspiration comes from a proposal which was formulated back in the 1940s by John Maynard Keynes as an international monetary system. He proposed, in fact, to create an international clearing union precisely with the purpose of financing temporary imbalances in the current account, but also ensuring that these imbalances were merely temporary, in order to remind all countries that there are two sides of the mirror. If you earn money by selling your products, you have an obligation, as Keynes put it, the obligation of the creditor to spend that money in order to allow the other people to participate in international trade by selling, in turn, their goods and services. And he aimed at achieving this through the establishment of an international clearing union which functioned pretty much like Target 2 with certain slight differences. The first difference, it was restricted to current account. We all know that one of the pillars of the Bretton Woods system was capital controls, no capital movements. This is one of the things which is usually said to say, okay, it's something which comes from the past. It's not viable in an environment where we have free capital flows, and we have been having free capital flows for the past 40 years. In fact, look at it this way. It's an environment where there is no need for free capital flows if the need for free capital flows is to finance temporary current account deficits. And this is the macroeconomic purpose of short-term capital flows. So this is the first point. The second point is that, unlike Target 2, the International Clearing Union imposed symmetric charges on debtor and creditor countries, meaning that in this special bank, not only debtors pay interests on their debts, but also creditors pay interests on their credits. And this, of course, provides an incentive for both types of countries to converge towards zero. Quotas, maximums. Today, it is inconceivable to set a maximum on the amount of Target 2 imbalances in either direction, because, as I argued before, this would mean the end of the euro. If the clearing union is used simply to finance current account imbalances, it's easy. You say, okay, at this point, you have exhausted your overdraft facility. That's it. Stop importing. And, of course, in Keynes's proposal, the international currency, which denominated the accounts in the International Clearing Union, was distinct from the national currencies. Bancor was different from the national currencies. And this means that you can adjust exchange rates in the case of persistent disequilibria in either direction. You have a persistent deficit, you devalue the currency. You have a persistent surplus, you revalue the currency. Of course, another option that we don't have in the Eurozone today, except if you do it by changing the real exchange rates through deep devaluation of wages, particularly in the periphery. So how can we move, this is the essence of the proposal, from Target 2 to a European clearing union? There would be, let's say, violent ways of doing this. Simply substitute in block T2 with the blueprint of the International Clearing Union. I won't discuss those because for obvious reasons. But let's provide a mild solution. The first point is to differentiate the money flowing across borders according to the purposes. So introduce cheaper refinancing operations if they are targeted to trade and foreign direct investments, in order to provide cheaper financing when it means converging towards the equilibrium. The second point, introduce symmetric charges on negative and positive Target 2 balances. Note that, in principle, this had been decided in June 2014, when the European Central Bank introduced a negative interest rate on the deposit facility. So I was assuming, on this basis, that today July 2017, we had negative interest on target 2 balances. If you look at the official site of the ECB, this is what it says. Upon my inquiry, the ECB specified that zero interest rate applies to both surplus and deficit balances because they apply the interest rate of main refinancing operations, which is different from what they said. I don't know for what reason. I have not been able to understand. But here it's simply a matter of sticking to the rules that we already have. Perhaps increasing charges as balances increase in both directions to strengthen the principle. And then adjust real exchange rates, possibly in both directions, until we don't have nominal exchange rates to adjust. And here I will borrow from what Heiner Flasbeck was suggesting before. If you have a persistent surplus, of course, your duty in a union is to revalue your currency, for example, through wage policies, why not, or through public investments. What are the advantages of this? I will be very brief. Money circulates and isn't hoarded, one of the main problems over the past 7 to 8 years. External debts are paid out and not floated or bailed out, as we are accustomed to do recently. Countries converge through a cooperative mechanism. Debtors and creditors are relieved from deflationary pressures, and I believe that creditor countries are starting to witness the evil consequences of this. Creditors benefit, creditors pay. In what sense do creditors benefit? A lot has been said already in this respect, but the clearing system makes apparent that you are benefiting from a common market. You are selling goods that you otherwise would not have been able to sell, just as on the other side you have people buying stuff that they otherwise could not have been able to afford. Simple. Trade and real investments would have a cheap and stable source of funding. Money would be created sufficiently and not too much or too little, which is the basic concept behind fiscal currencies in the first place. And these charges, symmetric charges, collected on target 2 balances could be used to fund the European Investment Bank or the European Investment Fund. Just very briefly, because I think we are already over time. Conclusions. As I said, and perhaps at this point has become clearer, this is intended as a proposal to escape this dramatic alternative between inside and outside, creating a complementarity between inside money and outside money. Imagine a fiscal currency together with the euro, which functions according to the rules I have just described. As an economic historian, I will point out that this would be simply a reinvention of what has characterized Europe for centuries. We have had throughout Europe, between Charlemagne and Napoleon, systems of complementary currencies where you would have a domestic currency for the domestic economy and a foreign currency for foreign trade, which was wiped out by that peculiar type of single currency which has already been evoked this morning, which was the gold standard, a precursor of the euro, so to speak. But we have an even more recent example in the history of the European Union, which is sadly very little known, and goes under the name of the European Payments Union. In the 1950s, in that period, which was a period of economic miracles, particularly in this country, but also in Germany, Europe had a clearing mechanism which functioned precisely according to the principles I have just described, from 1950 to 1958. Just 2 hints. You can have fiscal currencies at a national level. You can have fiscal currencies even at a local level. History is generous even in examples of this sort. What I'm showing you here is very famous experiments in the early 1930s during the Great Depression in Virgil, Austria, of a stamp strip, which was inspired by a heterodox economist praised by Keynes, but let's leave aside all these cranks. More prominently, this was endorsed by Irving Fisher, very mainstream economist, in his book Stamp Script, describing particularly tax anticipation scripts, which are literally fiscal currencies at a local level. Another example, which has been already quoted, corporate mutual credit systems. We have one in Italy, quite successful, growing in Sardinia, Sardex. There is one, the prototype, I would say, across Europe, in Switzerland, in the form of the Via Bank. But I will stop here and thank you for your attention.
I thank Luca because in a certain sense he offers not only some key considerations and make also an historical reconstruction or how and when the fiscal currency has been implemented, but also because he spends some words on the target to payment system, and actually that is a core piece of our euro architecture. I think that to the benefit of the audience, I will try to spend some words, I will try to add some words on what Luca has said about the Target 2 system, because maybe also it should or could help the audience in following some pieces of the reasoning that has been conducted during the day and also during the talk of Luca. You know, it's quite a simple object. It deserves to these, let's say, transactions. I will give you a couple of examples just to you to, catch what this system does. If an Italian bank buys an Italian BTP from a German bank, the money will not move from Milan to Frankfurt with a car, okay? But this transaction between the two banks is recorded on this system where the two correspondent central banks has an account. It means that, in this case, the Bundesbank records a credit towards the Bank of Italy. If an Italian bank settles a credit, a debt that he has towards a German bank, as well, the Bundesbank records a credit towards the Bank of Italy. If an Italian bank invests in a German fund, you have again the same kind of registration within this accounting system. By looking at this system, you can understand the inflows and the outflows, where the money goes within the Eurozone. Think, not only Eurozone member countries can belong to the Target 2 net payment system, but also European countries. But a rule is there that net balance should be also settled to zero. So why, by sharing the same currency, Germany and Italy can keep this incredible imbalance, on which I will spend some words, a country that belongs to the European Union but not the Eurozone must move around zero. Why this? Because the general idea is that this imbalance should be close to zero. Look, in United States of America, there is a similar system. The name is not Target 2, but very similar. You know, the only time in which they realize an imbalance of $1 trillion is during the Lehman Brothers collapse. So in other words, when something very bad happens on that state, on that union, they record a similar imbalance within the Target 2 net payment system. That is not created to have imbalances, because actually it should work without these imbalances. But let's now study the picture that Luca Luca, can you help us just for a second? Because I think that you stress important points. Can you take it again, the picture of the target to balance the trend? Just 1 second.
No, I can't. Where is that?
It was on the
It's
PowerPoint.
here. There you go. Target 2 ti serve, giusto?
Yes.
Okay, there you go.
Okay. You see on this picture that we have 2 peaks, 1 year and 1 year. These peaks coincide exactly with the extraordinary intervention of the European Central Bank. The first one is the long-term refinancing operation, the effect of that intervention, and the second one is the quantitative easing. Why this, and why this balance show a similar imbalance? Because the first pioneer of this research on this point was Antonio Foglia, that was one of our speakers in the morning, that highlights this thing, on some researches. The point is that when the German banking system has financed the buying of its manufacturing towards the periphery, I will be more clear. The Italian citizens were buying the German products by taking money from the banks that was given by the German banks. It's a typical vendor financing scheme. Obviously, it was increased the credit of the German banking system with respect to the Italian banking system. In a certain sense, when it arrives the money of the European Central Bank, this money deserves at that time to 2 main goals. The first one, they give liquidity to Italian and to peripheral banks to repay their debts. Otherwise, the credit risk exposure of the German banks would have found a problem. But in order to reduce this credit risk exposure, the banks of the periphery has received the money and repaid this debt. We don't make a mistake if we say that at that time the European central banks, in order to save the German banking system, as before saved the peripheral banking system. You know of these, for example, in Italy, we receive 270 billion of euro within the 1 trillion health roll. We use 220 of this money, 220 billion of this money, to repay our debt, our public debt. That the German banking system and the French banking system was the leveraging. Because despite the logic of risk sharing, they does not want to keep for 1 second more the Italian or the peripheral risks on their desk. 50 billion of this money deserves to Italian banks to repay their debt toward German banks. I will give you the same picture, the same figures for Spain. 220 billion of euro, 150 deserves to Spanish banks to repay their debt toward the German banks, and the rest to nationalize the public debt. It's not the case because the relationship between private and public debt in Spain and Italy is exactly the reverse. We have big public debt. The largest part of the health roll deserved to the nationalization process of the public debt. And so you see this attitude. And obviously, when the health roll, these loans, because these were loans, were reinstituted, were given back from the periphery towards the European Central Bank, look that the peak starts to reduce. Because the banks of the periphery were giving back the money to the European Central Bank. What happens later on? Since the risk nationalization process have finished to use the private banks, you cannot stick in private banks all their public debts because they finishes the assets. They cannot buy govies forever. At a certain point in time, we need to use another subject to conduct this risk nationalization process. The new subjects were the national central banks. Bank of France, Bank of Spain, Bank of Italy. And so the German traction quantitative easing invented a very interesting structure for this tool. Instead of making like for the Federal Reserve, the central bank buys the bond, buys the govies. It's bread and butter. It's like solve a first order differential equation. But instead of doing this, what they did, they prefer to give money to the national central banks in order that they would buy their public debt with the money given by the European Central Bank. Think about target 2.
Sorry, here.
No,
there you see it.
and you see exactly there. But let's see the new peak. But obviously, under the target 2 net paying system, what does it mean? It means that the Bank of Italy increases its debt versus the Bundesbank. And so you see that if you sum Spain and Italy, you more or less get the Germany net balance on the target 2 paying system. What is worse in this picture is that what will be the next step if we don't revert the story? Private banks has exhausted their energy in order to nationalize the public debt, their public debt. National central banks has been required to do the same. Now within the Bank of Italy we have 220 billion of BTP. So if we don't change the attitude of the European policies, really I don't know what would be the third step. And in fact the Euro bureaucracy is thinking about a step in which they will securitize part of the govies because the rest must become junk bonds. So really it's interesting the proposal that Luca was saying in line with the Bangor Keynes proposal. Think about for Germany to pay money for having a surplus of 900 billion of euro. And think the other way around for the countries in deficit. Because obviously, if the monetary policy interventions are not risk shared, all the time you will see here on the target 2 net balance something that does not work. I think that that is important to realize. The target 2 net balance eventually represents the risk segregated attitude of the Eurozone policies. Actually is a measure on how much risk has been segregated within the balance of our banks and central banks. I think that we have covered a big picture about the Eurozone architecture from this morning at 8:30. I think that you merit a coffee. And obviously it is for you really. Thank you very much.